Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
New high, let's buy. Okay, market broke above a resistance, is a new high for the move. Why don't you buy it? Small, real body. All right? Okay, I wouldn't be selling short because it's still a new high for the immediately preceding move. All right? But knowing not to buy here could have saved you thousands of dollars, depending on the position you took. If you bought up there, look at what would have happened within just a couple of sessions on this intraday chart. Okay, so safety first trading. Okay, some of you may know about Warren Buffett's rules of money management. Don't lose money, and don't forget Rule 1. Okay, so while the candles are great at letting us define risk reward and helping us avoid losing money, knowing not to, for example, go back here, not to go long up here. All right. There are some limitations with candles, and I'll just talk about one of them now, is that candles do not give price targets. Okay, candles, their main ability is letting you spot those reversals for timing your option trades. Okay, I do a lot of joint seminars with the top option traders. They talk about their option strategies, then I talk about the candles for timing. Okay, candles, when you fully understand them, will let you recognize the opportunities to shift into option trades. I don't discuss volatility, but I do discuss, changing trends, and that's one of the important aspects, as we know, about a potential option trade. But one of the limitations is candles don't give price targets. So that's why you need Western technicals. In fact, I had this cartoon made up about not giving your price targets. I can't tell you how far it is, but I do know it's that way, right? And it's like that with candles. We don't know how far the market's going to move, so you need Western technicals. But, you may look at prior support or resistance to get a target. So let me go back here, and I'll show you another slide, but we'll kind of go back and show you this. So, for example, over here, and I'll just clear all this up. Okay, so over here, the market stalled at the top end of the box range. My first target would be here. I'd make this S1, first support. And then my more liberal target would be S2 over here. But see, my targets have nothing to do with candles. They only have to do with prior support areas, as you would have on a bar chart. You certainly would incorporate those on a candlestick chart. So with this in mind, let's look at some ideas here. So over here. So I forgot I had the slide, so I didn't have to go back. But anyway, here at the bottom end of the trading range, on that yellow arrow, we have a bullish engulfing pattern confirming a support area. So we could look at this as a box range. Now, you don't know it's a box range until you actually have these 2 points over here, all right? So here we have another bearish engulfing pattern and so forth. So let's look at an if-then scenario. So here we have a candlestick line in the yellow arrow. This is the dollar-yen. And that's not a hammer, by the way. Once again, we don't have time to go into the nuances. This upper shadow is a little bit too long. But we do have a long lower shadow showing us that the market's rejecting lower levels. Then a couple of sessions later, you should all recognize what this is. Okay, a bullish engulfing pattern. So you can think about going long a call. Okay, so the price is around 90. So you can think about, again, let me show you what my resistance would be. Okay, my resistance or my target would be here. So if we're looking at a price around 89.50 and our target is 94, you could be looking at a 92 call or a 94 call. Obviously, the more out of the money, the more highly leveraged you would be. But I'd be perfectly comfortable suggesting a 94 call because that's my target. And also, obviously, you set a stop below the bullish engulfing pattern. If it closes under there, if you're long, you're wrong. So we did get to the target. So let's say you bought the 94 call. We got to the target. Candles don't give timing. We don't know if it's going to get there, within 2 days or a month. But my suggestion is, you want to give us some time, so you don't want to do, an expiration that's less than a month away, because the time value is just going to suck out the premium. So here, our target is that resistance area on 94. Now, what happened is, notice the market started to define a resistance area. You have a doji over there and so forth. So we're learning something new about the market. The analogy I like to make is we're all detectives in the market, and the market's giving us clues about what we should be doing. So here the market is stalling. So if you're long the call there, nothing wrong to take some profits. You probably would not be giving up much in time value decay because this resistance area started only a couple of days after. So you lock in some profits. Now you're playing more with the market's money. But we haven't reached our ultimate target yet, so you locked in some profits there, liquidate some long calls, and then you let the rest ride. And right at the resistance area, look what you get, a bearish engulfing pattern. So if you bought say a 94 call within whatever is a few weeks, you would have reached the 94 target, would have liquidated the remainder of the calls, and then you could have gotten out on the bearish engulfing pattern. Or if you were flat, okay, say you didn't go along the calls back on the blue arrow there, you're flat, you could view this bearish engulfing pattern confirming a resistance area as a time to buy puts. All right, and we're looking now. Remember, the candle signal is not completed until the close, so we would be close. So we'd be at a price around 92.50. The target, all right, would be my first support area would be over here, but the more important target. Remember, we talked about engulfing patterns of support. My target would be the major support area at the low of the bullish engulfing pattern. So the analysis is you might have gone through. Again, I'm not looking at volatility. Volatility is something that I'm not focusing on here. So taking volatility out of the picture, you're looking at the price is around 92.50. Your price target is around 87. So a little bit more leverage, maybe an 86 put or maybe an 88 put as a target. And again, we got there. The market had a nice bounce back, so you could have profited on your long put position. But this is just an example of the ease or the power of using candles and potential reversals, and then thinking about some option trades, some strategies using the ISE options. So let's go over what we did today, and then I'll tell you how to get some educational resources, including how to get my all-time most important trading rule. But let's go through this. We saw how candles, and I had this little picture made up, ascending the steps of knowledge to get to the golden key of confidence. How candles can be used in all time frames. So everything I did today, we looked at intraday charts and daily charts, can be used in any time frame. How candles reveal market psychology. Okay, long lower shadow means the market's rejecting lower levels. A bullish engulfing pattern, the bulls are in domination or taking control from the bears. How candles can protect trading capital, so the low of the hammer, okay, should be a support area. Okay, if the market closes under that, you're wrong. Candles in context, I could spend hours on this. Okay, looking at the candles through the prism of the overall market. Early in the seminar, I talked about there's a lot of misuses of candles, how people will use a candle signal to buy or sell, and that's really dangerous. Okay, there are times to use a hammer to buy. There are other times to use a hammer to only offset a short position. But candles have to be viewed through the prism of the overall market. So to me, it's much more important if a candlestick signal confirmed a Western signal. I know I keep on saying about the session because it's just that important. And that leads us to the next bullet point, the ability of and the importance of East and West. Okay, I call that your 1-2 punch for trading success.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.